Hey, we are ready. Chapter 17. Let's start going over the cash flow statement. Today I'm going to teach you how to do cash flow statement. First, to identify the purpose of the cash flow statement. Why do we need this cash flow statement? And who needs the cash flow statement? Now, the cash flow statement is going to show you if the company has ability to generate cash and for when they generate the cash, where the cash goes. So we're seeing what's coming in and what's going out. The cash flow statement is going to tell you how the cash has changed during the year. Did it increase? Did it decrease? If there's increase, why there's increase? If it decrease, why there's a decrease? And the statement, the cash flow statement covers the same period that the income statement and balance sheet covers. So basically, uh, those three statements are for the same period of time. Now, how are we going to do this? Now, the financial statements of the timing within the period. In the beginning of the period, we have a balance sheet, which is our starting point. At the end of the period, we have the balance sheet, which is the ending point. And the income statement, statement of retained earnings, and cash flow statement explain what happened from the beginning balance to the ending balance. So once we see the beginning balance and ending balance, there will be differences. Income statement explain the differences. What's the differences related to the operating activity in terms of revenue, expenses, net income. Statement of retained earnings shows what changes have happened to the owner's capital, and the cash flow statement explains what happened with the cash and cash only. So basically, what we have to do, we have to do a very close dissection, if I have to say that, dissection on the cash account. So we're going to see what the beginning balance is. We're going to find where the ending balance is. And we're going to start digging and to find out what happened. So in this debit side, from where the cash coming, cash can come from the customers. Usually the main source of cash, customers, once the customer pay their invoices or for the services and goods that we provide them to them, we're going to have cash. Then we can have some cash from some other activities which happen in the company. One will be the investment. The other one will be if we issue shares, company get cash. If we issue bonds, long-term debt, company get cash. If the company make investment in the shares and those shares pay dividend, the company is going to get the cash from there. And if we the one who uh, borrowing the money, we're going to get those borrowings in form of cash. Now, where the cash goes, so many activities. First will be operating activities. We have to pay to our suppliers, we have our employee, to our income taxes. Then we're going to go with the capital purchases, which will be the assets. We may give a loan to another company, or we may pay dividend to our shareholders to make them happy, or we can repay the bank loan that we already borrow, or the long-term debt that we also borrow in terms of bonds if we issue bonds. So basically, those are the decreases, and as you can increase, so many increases. But at the end of the day, we're chasing the beginning balance. We're going to add the increases. We're going to deduct the decreases and see what the ending balance is. Purpose of the cash flow is to help to predict the future cash flow. If we see the cash flow is healthy, that means the company is healthy. That means we as investor, we may invest in that company. Obviously, the cash flow can show you how the management dealing with the situation and what kind of decision they're making. If the cash flow improving, and that means the management doing the good decisions, determine the company ability to pay the dividends. Obviously, if the company has a cash and generate cash, the company is going to be healthy and is going to be able to pay dividends, or it's going to pay debt. Because at the end of the day, if you're the one who lending the money, the only thing that you worry about is the institution or the person that I'm giving that lending the money has ability to generate cash. You won't lend money to somebody who not have income. You want to get your money back. And that's going to show the relationship between the net income and the cash flow. or how the net income transfer to the cash flow. Now, the purpose again is the negative cash. If we see the negative cash flow from operating activities, operations, we may raise a red flag for the company. That means this company doesn't generate enough cash from its operating normal operations. What that means is the business that they're running is not successful. If you see a negative cash for the period of time, like two consecutive, I won't wait two consecutive. If I see the first year and the first check point on the second year around mid-year point is still negative, that means you're clearly losing. Now, transfer this to the government spending. As you can see, all the governments right now, they're running on the negative cash flow statements. All the governments around the globe right now, they're running on the negative cash flow statements. What that means they're spending more than what they can generate as a cash. The question is, well, from where they get the differences? Well, the difference is they're getting it by borrowing money from another institution, mostly private institutions, and the other options will be just to print new money. If you're big enough to can bring the money. Where that's going to bring us, if the company, as you can see here, if the business running 2 or more years, two consecutive years on the negative cash, that company most likely going to go into bankruptcy. That raised the question, is the government going to bankrupt? That's an interesting idea, but we might witness something in the future. We'll see how that goes. Now, the cash and cash equivalent, what is cash and what is the cash equivalent? So which changes we're chasing when we say cash? When we say cash, we don't mean only the bills that we have in our pocket. We're also considering the bank accounts and also considering a highly liquid short-term investments. What means highly liquid? That will be easily converted into cash. For example, if you have investment in GIC, which GIC is cashable at any time, that's considered highly liquid short-term investment. So that's considered purely cash. Why? Because anytime you can convert it back to cash. But if you have a GIC, term GIC for 1 year, which is not cashable, or which is cashable only and only on the due date, which is 1 year from now, then that's not going to be considered highly liquid short-term investment. Anything which is on the money market or government of Canada Treasury bills, that will be considered also short-term investment or highly liquid investment, which can be part of the cash. So the cash is not only cash as a bills, not only cash as a bank account, not only cash as foreign currencies, but also very high liquid short-term investments, usually those ones which are cashable within 3 months. Now let's start identifying the cash flows that are coming into the company. Now the processes that happen to the company, we have three processes in the company. One, it's coming directly from the operating activities. Operating activities means the main business of the company. Then we have the next flow of cash that's coming, the next section of the cash flow that we're going to see, that will be the investing activity. Investing activity is any cash that company spends or gets in form of investment, which is related to the long-term assets and pure investments in other corporations, in form of common shares. And the last one will be the financing. Financing will be where the company get the cash in terms of liabilities and equity to company owes money, and that's how we can see it. I'm gonna talk a little bit more and explain a little bit more. That's just very briefly. Now, the format of the cash flow. There are two ways to prepare the cash flow. One is called direct method. The other one is called indirect method. I'm gonna show you both methods, even though in this usually in the practice in the classroom we usually teaching only and only the indirect method. Direct method is assumed uh, to be easier than indirect method. And for that reason, maybe for that reason, I don't know for what reason, but we're not teaching, usually we're not teaching the direct method. However, I'm going to show you direct method as well. The indirect method is the one that we usually teach again, and that comes indirectly from some point of the time. So the indirect method, we clearly see and identifying the cash flow as two streams of cash flow, cash in and cash out. And then we're chasing from where the cash comes in the company, from which resources, and how much cash we collected. And then we're going in the cash out, we're chasing the where the cash went. In the indirect method, we're starting with some point of time, which is net income. Then we make adjustment to the net income. To bring the net income to the cash income, but now the direct and indirect method affects only and only operating activities of the company, which is only one part of the uh, cash flow statement. The other two activities, for them, we're using. There's no changes in the direct and indirect method. So indirect direct method applies only and only to the operating activity cash section. Now, both methods obviously is going to come with the same result. CPA Canada Handbook and Accounting Standard Board approve both formats. They encourage direct format, but in the industry and everyone who preparing the cash flow statement, everybody preparing us using the indirect format for the operating activity. Again, financing, investing activities, the method, there's only one method. So for that, there's no problem for that. Now, the other thing that I can tell you right now is usually in practice, the corporation or the companies, they don't prepare in cash flow statement. Why? Because the cash flow statement cannot be prepared. In North America, accounting software cannot prepare cash flow statement. So the cash flow statement usually is prepared by hand. For that reason, uh, most of the companies, small companies or mid-sized companies, they don't provide the cash flow statement. So for that reason, I want you to know how to prepare cash flow statements. There are three basic categories in the business activity. Again, operating activity, investing activity, financing activity. If you can notice, all those terms are in ing form. Operating, not operation. Operating activity. Ing form shows continuation. That means that activity is going to continue for the foreseeable future. Investing, not investment activity, investing activity. Financing, not finance activity, financing activities. And all the cash flow statement in under those three sections. Now, operating activity. Operating activity is the one that we're gonna chase from where the cash coming from. And the operating involve revenue, expenses, gain, and losses. Operating activity obviously is going to affect the net income. They're going to affect the current assets and current liability on the balance sheet. And operating activity is the most important category on the statement of the cash flow. Why? Because again, gives information to the investors if this company has ability to generate cash from the main operation. If the company saying, okay, I'm a coffee shop, But my cash coming from selling uh, computers, something is wrong with the company. We would expect the most cash to come from selling coffee, from the main business. Investing activity, investing activity increases or decreases in long-term assets, which obviously is going to include purchasing and selling those assets. Also, it's going to include lending money to the others and collections of those money. And the other one is if you invest in the common shares of another company, that will be another uh, source of cash, which is related to the investing activities. This is the second important because shows the after the operating activity again shows the ability of the company since. So watch this. If through the operating, the whole idea is through the operating activity is you to generate cash. Once you have enough cash, and obviously you're going to have excessive cash, the question is how well you're using that excessive cash in order to work for you. The investing activity is going to give you that information how well the company managing the extra cash that they're getting from operating activities. Financing activity will be the increase and decrease in the long-term liability and equity. That will including the issuing of shares, paying the dividends, borrowing money, and paying the loans. And that's the last important or least important section of the cash flow statement compared to the operating and investing activities. So how we can see this? This is one way to look at it. Operating activity is related to the working capital. Working capital is the current assets and current liability. Investing activity dealing only with the long-term assets. Financing activity dealing with the long-term liability and owner's equity. In other words, I'm going to stop sharing this. I'm going to open the Excel spreadsheet, but I'm going to start far behind. And we're going to do this cash for the Excel spreadsheet together because I want you to see it. So you can understand the idea with the accounting and idea with the cash flow. Both are related. Accounting is closely related. From the accounting information, you can get the idea about the cash flow statement. So here's my Excel spreadsheet. Now you can see it. So what was the basic accounting equation? Anyone interested to help me here with the basic accounting equation? Do you remember it? The basic accounting equation is assets are equal to liability plus equity. That's our basic accounting equation. Now, if we take a look at the assets and see what's in assets, we're going to see that the asset has two components. That's too much. Let's make it a little bit shorter like this, and maybe you can delete two of those, and that will be. So on assets, we have a current assets, and also we have long-term assets, and that constitute our assets. Let's flip it here to be consistent, and we have the long-term assets. On the liability, we already saw this in this course. We have current liabilities, which are due within 1 year, or current operating cycle of the company, which whatever is longer, and we have a long-term liability. And the last section that left is the equity section. In the equity section, we already see we have a contributed capital, and we have a retained earnings, which retained earnings come from the income statement or any income which is kept in the company, that's constitute retained earnings. So now how can we look the cash flow statement? Out of this equation, I'm going to make it a little bit smaller, just a little bit, 48. Out of this equation, what we can draw and how we can interpret the cash flow statement. Now, the current assets and current liability, those two, it's going to give us our operating activity. In the cash flow statement. Only those two. Current assets and current liability. Then we have the long-term assets. And the long-term assets are the one that give us our investing activity. And then left only those one, which I can flip it now here. And those three, it's gonna give us our financing activity. And those are the three sections of the cash flow statement that we have to prepare. So in order to prepare operating activity, we have to see how much cash comes from the current assets and the current liability. From the investing activities, to get that section, we have to find out how much cash came and went out for the investing activity, which are related to the long-term assets, and financing activities. We have to find out how much cash came in and get out on the activity related to the long-term assets and equity, which is contributed capital and retained earnings. This simple explanation. Now, before we continue back and go back to the slides, I want we to cover something, which is very basic, but I want we to go through it, so I know that you actually know it. So I want we to follow the cash in the company and find out from where the cash coming in. I want we to look at the flows of the cash. First, we have a cash inflow. And then we're going to have a cash out. First is the cash inflow. From where the cash is coming. So let's think about it. The company is going to have sales, correct? Which coming from the sales account. We're going to have this T account, which is our sales. Then these sales, we want ideally to be converted into cash. And that cash, just a second, let me get rid of this. I want to put it here. And that cash is going to have beginning balance, ending balance. That's what we're chasing. In the cash flow statement, we're going to start doing the research from where the cash, what has happened in the company to change this balance. Now, everything which is on the left side of the cash flow statement, of the cash account, that's our debits. Those constitute our debits. On the other side, on the right side, that's our credits or cash in. This one is cash in, this one is cash out. Now let's think about it. The company generates sales. If I'm running a cash company, which is, let's say I'm running McDonald's, right? McDonald's restaurant, and my sales are $100. How much cash I'm gonna get? If my sales are $100, how much will be my cash?
100.
Sorry?
100.
100. Is this clear for everybody?
Yes.
Why is that? Because you cannot walk out of McDonald's before you pay. Make sense?
Yes, bro.
So what that means is they're running cash business. Purely cash business. What's interesting with the cash business? When they make the sales, they collect the money. End of the story. Is all the businesses working in this model? What do you think? Is the all businesses in North America working in this model, in the cash model? The answer is no. So what that means? That means the company, right? Company generate the sales. So ideally, you want that sales to convert directly to cash. Whatever you're generating as a sales to go directly to cash. That's what you want. Once you achieve this, you're in the perfect conditions. But the problem is that most of the time, this chain is broken. What that means is the whole sales cash chain is broken. And we have something in the middle. What account we have in the middle? What do you think? Which account will be in the middle? So you're making the sales, you're not collecting the money. What account will have in the middle? Which also gonna have a debit and credit. Also gonna have a beginning balance and ending balance. How is that account called? Do you know? That's your accounts receivables. So what's happened now? Instead of having sales going directly to cash, sales now go to the accounts receivables first. And once the accounts receivables are collected, then move to cash. So we don't have only one line here. We're gonna have two of those. So first will be related to the accounts receivables coming from sales. So that will be my sales in accounts receivables. And the next one is gonna catch my accounts receivables going to cash. So instead of one chain, I have two. So let's play a little bit so I can understand it. If I don't have accounts receivables, my sales are converted directly to cash, correct? Can you guys see it?
Yes,
If I don't
correct.
have if I don't have accounts receivables, whatever I'm selling, I'm getting the cash. Now let's play a little bit. If my beginning balance of the accounts receivables is $20, my sales are 100. My ending balance on accounts receivables is $20. How much cash I collected? What do you say?
80.
80.
So let's think about it. My sales are 100, right? So if I don't collect it, those 100 is gonna come here. Correct? How much has to go out and move to cash in order beginning balance to be 20, ending balance to be 20?
100.
100. So how much cash I collected?
100.
100. Does that make sense?
Yes, bro.
So what will be the formula? The formula, simple formula will be sales plus beginning balance of accounts receivables minus ending balance of accounts receivables is going to be give me the cash collection. Let's test the formula and see is this actually true. My sales are 100 plus, no, sorry, plus beginning balance is 20 minus ending balance is 20. It's going to give me, how much is going to give me?
100.
100. Now, let's see if this formula works. So let's change it a little bit. My beginning balance now is 0. My sales are 100. How much cash I collected?
100.
Let's see. My sales are 100, correct? My sales are 100. Plus, how much is my beginning balance of accounts receivables?
20.
Where do you see 20?
Oh, 0.
It's equal to 0. Minus, how much is my ending balance in accounts receivables?
20.
20. How much cash I collected?
80.
$80. Does that make sense? Why didn't collect? Why my cash is less than $20? Why my cash is 80? Why is not 100?
Because the beginning balance is 0.
Because I didn't collect my sales. I collect from my sales only $80. The other $20, the customers hasn't paid yet. It's sitting in the customer account. Make sense? Do you understand this logic? Or shall we start again? Talk to me, people.
Can you start again?
Start again,
Start,
Professor.
start again. Let's start again. Again, I'm running cash business. I'm making hot dogs and I'm selling hot dogs. If I sell you my hot dog for $20, do you have to pay me for the hot dog?
Yes.
Yes. Why? Because if you don't pay me, I'm not going to give you the hot dog, right? So if I sell today 5 hot dogs, that's $100, correct? How much cash I'm going to have?
100.
$100. But that's only and only when you give the hot dog, get the cash. Make sense? Do you understand this logic?
Yes, Prof.
Now, not all the businesses running cash sales. Some of the businesses, they bill in the client and client later pays. So when this chain between sales and cash is broken, we have a new account in the middle, which is accounts receivables. What's interesting with accounts receivable? Accounts receivable have beginning balance and ending balance. Now the ending balance is equal to beginning balance plus the debits minus credits, and it's going to give you the ending balance. Now, if my beginning balance is 0 and ending balance is 0, and if my sales are $100, how much cash I collected? Are you guys with me? Again, if the beginning balance of the accounts receivables is 0, ending balance is also 0, how much cash I collected?
100.
100. Then what's going to happen in accounts receivable account in this case? In accounts receivables account, I'm going to have debit of $100 and credit of $100. So that means everything that I sold become collectible from the clients. The clients pay me the money and I have my cash. Make sense?
Yes.
Okay, now let's start playing with the scenarios. I sold $100, my sales are $100, but the client didn't pay me $100. They pay me only 80. How much cash I get? Did I get 100?
No.
No. How much I get? 80.
80.
Make sense?
Yes.
So whatever I have here is going to transfer into my cash. This is my $80. This is my sales, 100. Make sense? Now it's more
Yes, Prof.
visible. Those 100 from sales going to accounts receivables. Now whatever I collect from the accounts receivables go directly to cash. Now the one scenario is when the balance is 0 here. Now let's play with a little bit. Now we don't know how much we collected. We don't know that. The only thing that I know is my sales. I know my sales. My sales are 100. And those sales naturally has to go to accounts receivables. Now accounts receivables account now has $10 beginning balance. Oh no, let's leave it 0. $0. Ending balance is 50. How much cash I collected?
50.
50. Make sense? Because the beginning balance plus the debit minus credit has to give me the ending balance. If the beginning balance is 0 plus 100 minus something has to give me 50. How much is that something? 50. So that means I collected $50 cash. So, can we express this by formula? Absolutely. What will be my formula? My formula will be my sales plus beginning balance. Let me format those cells. Let me grab those one here and put it right here. It doesn't give me. So my beginning balance was 0. My ending balance is 50. How much cash I collected?
50.
50. Is that clear now for everybody?
Yes, Prof.
Okay. Let's make a little bit more challenging. Now, my beginning balance is 20. My ending balance, I don't know how much I collected. I don't know how much cash I get it, but I know my sales are 100. My beginning balance in accounts receivables was 20. My ending balance is 0. How much cash I collected?
120.
Did I collected my sales? 100% of my sales.
No.
What do you mean? Did I, whatever I sold during the period, did I collect it? If my ending balance is 0. Did they collect those $100? What do you say? Yes or no?
Yes.
Yes. If my balance is 0, that means I definitely collected the sales. Did I collect more than my sales?
Yes.
Yes. What I also collected? I collected my sales plus I collected the $20 that the clients owe me from the previous period. Make sense?
Yes, Prof.
So what happened in here is, let's put this formula and let's plug the numbers. Sales are 100. My beginning balance accounts receivables is 20. My ending balance is 0. Collection will be this one plus this one minus that one. The cash that I collected is $120. Make sense? Are you guys with me?
Yes, Prof.
Yes, Prof.
So 120 here and 120 here. One thing that I want you to realize, if the ending balance is less or equal to the beginning balance, you definitely collected the sales for the period. Now let's make it a little bit more difficult. Let's get another scenario. Do you want me to save those scenarios and do those scenarios on the separate sheets?
Yes, Prof.
Okay, let's go with the first one. First one was 100. Then we have here 100. Then that balance was 0. And that was 50. And we collected ending balance is 50. That means we collected only $50. And that's our calculation here. Let's delete this one. And that will be our first scenario. Let's move to our second scenario. In the second scenario, what we said, my sales are 100. My beginning balance was 20. We don't know how much we collected. So our collection here will be equal to whatever formula is going to give us. And the cash is going to give us to put that collection as well. So sales are 100, which come in here. Beginning balance 20, ending balance was 0. How much we collected? 120. What that means? The sales, we collected the sales, plus we collected the $20 from accounts receivables that we have from the previous month sales, and we collecting $120. Now let's do the third scenario. Let's make it easy again. If my beginning balance is 0, My sales are 100. How much cash I collected? Are you guys with me?
Yes, Prof.
So my beginning balance is 0. Ending balance is 0 accounts receivables. What that means?
We
I collected,
collected the 100.
yes. I collected my sales. Whatever I'm selling, I'm collecting it. Okay. And Control C, Control V. Let's see now. Let's add beginning balance is 10. Ending balance is 20. Let me delete those one. Ending balance is 20. How much cash I collected?
90.
90.
Can you actually see it? Why is 90? Because beginning balance is 10, ending balance is 20. So my accounts receivables increase with $10. What that means? I'm not collecting $10 from my current sales. My current sales are 100, so that means I'm collecting only $90. I'm not able to collect my sales. Do you understand this? So if the ending balance of accounts receivable start going up, you are not collecting your current sales. On top of that, you didn't collect the sales from before if you have a beginning balance. Now let's see the other scenario. That will be actually the last scenario, and we're covering all the scenarios here. Let's now let me erase those ones so they're not gonna, and I'm gonna get rid of this one as well. My beginning balance accounts receivables is 50. My ending balance is 10. How much cash I collected?
140.
140. Thank you. How did you get it?
Beginning balance plus the sales minus the ending equals 140.
My sales are 100. My beginning balance is 50. My ending balance is 10. So that means I collected 140. Is it easy now? Can you start seeing it now?
Yes.
Yes, Prof.
Okay, good. Let's call it that cash in. Let's see now what's going to happen with the cash out. Right? We found the cash in. Let's go and check the cash out. For the cash out, I have to do some adjustments here, obviously, right? We're not going to stay with accounts receivables and everything like that. Let's get rid of those first. And let's exchange those ones. But in this time, my cash will be on this side. Purposely, it's going to be on this side. There will be nothing here for now. We're going to add it later. Let's move it somewhere that you cannot see it for now. Not to be distraction. Cash outflow. And on this side, we're going to have expense. Now, expense that's not beginning balance. There's no beginning balance on the expense. Let's not confuse you. Not ending balance because that's a simple income statement account which has simple debit and credit. That's all. So we have our expenses, expense account. On which side the expenses go? On the debit or credit side? What you gonna tell me? Expenses, on which side they going? Debit or credit?
Debit.
On debit. So if I purchase expenses, so let's say I'm going to where I'm going? Staples. And I buy $100 supplies. Or let's go with a different number. Let's go with $200 supplies. How much cash I have to pay?
200.
200.
200. Is that clear for everybody?
Yes.
Why? Because they're not gonna let me go out of the store. But is the all the businesses cash businesses? Obviously no. So what will be in the middle? If we don't pay the cash right away, what I'm gonna have in the middle?
Accounts payable.
Payable.
Accounts payable. So if that chain is broken here in the middle, instead of accounts receivables, now I'm gonna have accounts payable. Let's get our accounts payable account. That's our accounts payable account. Now let's see what's happened now. When I get the expense, right? When I grab the expense first, I'm not gonna pay for the expense. And that's gonna increase my liability. Now I have to pay them. Make sense? So if I get the $20 expense, that's gonna give me, $200 accounts payable. And if I pay those accounts payable right away, I have to use cash. Otherwise, I cannot pay it. And once I use cash, my cash going down, but my accounts payable also goes down with the same amount. Make sense?
Yes, bro.
Okay, so now let's see how this works. If my beginning balance on accounts payable is 0 and ending balance is 0, what that means? Whatever I purchase as expense, I already pay it. Make sense? Can you see it? If my beginning balance of the accounts payable is 0 and ending balance is 0, whatever I purchase, I pay for it. So what will be our formula? It will be expense plus beginning balance of accounts payable minus ending balance of accounts payable. It's going to give me the cash outflow. Make sense? Now let's test this formula to see if this formula actually works. Because you can say that's a very good formula, but we don't believe it. Which will be a fair comment. So now let's see the expense. How much my expense? My expense is $200. My accounts payable is 0. My ending balance of account payable also 0. So my cash outflow will be my expense plus beginning balance minus ending balance, $200 cash. Now let's start playing with the scenarios. What will be the first scenario? First scenario, let's go with, okay, I purchased 200 expense. Let's get rid of this. My expense was $200, but now accounts payable has a zero beginning balance and the ending balance is $80. How much cash I paid?
$280.
Hold on a second. Did I pay for my expenses? Did I pay all the $200 first? If I have ending balance on accounts payable, do I owe the people money?
Yes, Prof.
Okay, how much I owe them?
200.
No.
Ano?
I purchased 200, but currently I owe them money. How much I owe them?
280.
Look at this. Accounts payable says how much I owe them?
80.
80.
$80. How much I paid? If I purchase 200 and I owe them $80, how much I pay them?
80.
Again, I purchased $200. I still owe them
80.
$80.
So,
How much cash I pay them?
120.
120.
120.
120.
Make sense? So the 200 is gonna come here, 200. Now the question is, how much have to get out of here in order my balance to be 80? So my expense, let's get this formula and let's play with the formula now. My expense is $200. My beginning balance of accounts payable is 0. My ending balance is 80. So how much is my cash outflow? 200 plus 0 minus 80. I pay $120. Does that make sense?
Yes, Prof.
So I purchased 200, I pay only 120, and I still owe them $80. So let's see another scenario. In the next scenario, let's mix it a little bit. My expense is still $200. Okay? My beginning balance now is $20. No, let's put it $50. And my ending balance is 0. How much cash I paid?
250.
250. Why is a question mark at the end?
250.
You have to be right away. 250. Why?
250.
Right? Because I pay for my expenses, plus I pay for the $50 that I owe from the previous period. And I don't have to pay anything anymore. So if I pay 250 here, 250, my balance will be 0. Make sense?
Yes, Prof.
Okay, good. Let's make one step further. Let's start mixing it. Let's go now here. Is it getting interesting or now it's getting boring? How is it?
Interesting, Prof.
Okay, good. That's the whole point, to become interesting. When become interesting, then you start learning. If it's not interesting, forget about it. So now, watch this. My beginning balance is $20. but my ending balance is 50. How much cash I paid?
One 170.
170. How did you get it? 200 plus 20 minus 50?
Yes.
Yes. Do you know how else you can get it? You're just checking the change. How much is beginning balance minus the ending balance? And if you take a look, those two, when you combine them, 20 is my beginning balance, 50 my ending balance. How much my accounts payable increase? With how much?
30.
With $30. What that means? Whatever my expenses are, I didn't pay $30 of my current expenses. So 200 minus 30, 170. That's another way you to get the formula. Make sense?
Yes, Prof.
So one way is get the expense plus the beginning balance minus the ending balance. It's going to give you the final result. That will be the one way. The other way is 20 minus 50 is minus 30. Minus 200, 170. That's another way to look at it. And let's see the last scenario, the last possible scenario here. The next scenario, let's mix it. Now, my beginning balance will be 70 and my ending balance will be 20. How much cash I paid?
$250.
250. 250. Why? Because I paid for my expenses, plus I reduce my beginning balance down to 20, from 17 down to 20. So I pay whatever I owed, I pay $50 for whatever I owed, plus my current expenses. So that will be 250. 250. And if we have to see the formula here, boom, 250. Good job, people. Do you understand now the cash in and cash out?
Yes, Prof.
Okay, watch this, the next thing now. What we say on the cash in? Cash in comes from sales plus accounts receivable ending, accounts receivable uh, beginning ending balance, cash collection, correct? Are you guys with me?
Yes, Prof.
So we have this formula. Let me bring this formula. Oops. Ah, here, this one. I fix it here, and then I forget it. Control C, Control V. Then, that's for my sales. Then I have my expenses. And for my expenses, I have accounts payable, cash out, correct? So, in direct method, this is exactly how we're doing. We're chasing the sales, changes in accounts receivables to get the collection, then less cash outflow. This will be add, then will be less expenses, changes in accounts payable. That's going to give us outflow. And that's how we doing the direct method under the operating activities. Now, what will be the difference between direct and indirect? So watch this. It's very simple, but I want you to see it. In the indirect method, What I'm gonna do is very simple again. C, Control V, let me flip this one first here. I'm gonna forget about the cells. Let me see how can I erase that one. I'm gonna get rid of the cells and I'm gonna get rid of the expenses. Why? Because I know the sales and expenses, what they're gonna give me. Sales minus expenses, what I'm gonna get.
Net income.
Net income. And I'm gonna start my calculation with the net income. Do I have my sales and expenses in the net income?
Yeah.
If the so listen this. If the sales minus expenses give me net income, once I start with the sales with the net income, do I have already my sales and expenses inside? Obviously I do. Obviously I do, right? If the sales minus expenses give me the net income, if I start with the net income, I don't need to get the sales and expenses because the sales are already in. Expenses are already in the net income. I'm just getting the difference between those two. And what else I'm gonna get? The difference in accounts receivables and accounts payables. And once I get those one, so I'm gonna start with the net income, then I'm gonna get the differences in accounts receivable, accounts payables, and I'm gonna get the cash flow for the operating activity. That's the only difference. In the indirect method, I'm using sales plus those, expenses plus changes in accounts payable. In the indirect method, I'm not chasing any more sales and expenses. Why? Because I'm starting with the net income. Net income is already have those one. So what I'm doing is only getting the difference between accounts receivable and accounts payable. And I'm getting my cash. That will be my cash collection. The other one will be my cash outflow, and I'm done. And that's the difference between one versus the other. Direct versus indirect. Okay, so let's go back to slides, cover a few slides, and see how the slides going. Again, let's go to the time that we left the slides, which is the operating activities are related to the current assets and current liability. Investing activities cover the long-term assets, and the financing cash flow or financing activities catches long-term liability and owner's equity. Moving forward, on what I'm going to do with the discontinued operations. Discontinued operations, if you have any discontinued operation on the income statement, that's going to be shown separately. Let's go now with the interest in dividend from the operating activities. Now, interest generally should be part of the investing activities. Dividend paid received, it might be part of the financing activity. Interest payment is also considered part of the investing. However, for simplicity, we're gonna include them in operating activities unless it's completely specified they to be part of the investing one. If the question tells you, the question usually is gonna tell you where to include the interest paid and interest received, and dividend paid, dividend received. But general rule is interest payments and interest received, operating activity. Dividend received, operating activity. How about the dividend payment? Financing activity. What are we going to do with the non-cash items? Do we have to include a non-cash item in the cash flow statement? Answer is no. If we have transaction where I purchase a truck, okay, and for that purchase of truck, I issue common shares, cash is not involved. For that reason, there will be no anything expressed on the cash flow statement. Now, if there's a cash component on the transaction, if we purchase something like here, purchase machinery for 25,000, I'm paying with the note payable 20,000, and the rest I'm paying cash. Then yes, the cash component, the 5,000, is going to show us a reduction of the cash. And it's going to be shown on the cash flow statement. What is the free cash? Free cash in the company is the one that the company have for investment purposes, will be net cash that the company gets from operating activity minus the cash payment for the investing, property, plant, equipment, and other long-term assets, and that will be your free cash from which you can now pay your debt or pay dividend. Now let's start preparing the indirect method. The indirect method. Indirect method, again, is different only, we have the difference in the direct and indirect only for the operating activities. And the difference is in the direct method, we starting with sales and then the changes in the working capital, expenses, then the changes in the working capital, where the indirect method, we starting with the net income, which net income already have sales and expenses. Now, for the accounting purposes, as you already know, in the net income, we including expenses which are accruals or deferrals. That means the cash is not involved. For that reason, we have to adjust the net income to exclude any expenses or revenues which are accruing the net income, but there's no relation with the cash. So let's start and see how it goes. Indirect method. Again, expenses, which has no cash effect, has to be added back. To revenue that don't have a cash relation has to be deducted. Why? Let's go to the Excel spreadsheet and think about it. It's very simple, but I want you to see it first and then we can talk about it. Let me open my Excel spreadsheet again. Make it a little bigger and share it with you. Can you guys see my screen?
Yes, bro.
Okay. Let me see if you can see what I'm typing right now. Yes. Okay. So watch this. I have an income statement, correct? My income statement starts with sales. Then I have operating expense. Then I have depreciation. expense. And once I deduct, let's say my sales are $100, my operating expenses are 50, my depreciation is 10. And I have net income, correct? My net income is 100 minus 50 minus 10. Now I'm start preparing my cash flow statement, indirect method, operating activity. My starting point is the net income. And the net income, as per this statement, is $40. Okay, fine. But then I'm asking myself question, is there anything of those expenses or sales which has no relation to the cash? And the question says, all the sales are cash. Okay, fine. So there's nothing here non-cash. So this one is fine. This one is check. Let's insert one check mark. What I'm looking for, symbols. And this one is check. Where is the check mark here? Looking, cash check mark. See, you can find faster some check mark so I can check it. Yeah, I can use this as a check mark. Check. 100, check. Next one, 50. In 50, they say all the operating expenses are cash items. Okay, next one, check. Now I'm going to the depreciation expense. And I'm asking myself question. Do I pay for the depreciation? Can I buy depreciation with cash? What do you say? Yes or no?
No.
No. So, is the depreciation related to the cash? No, it's not. So what do I have to do? So basically, right now, because depreciation expense is included in my net income is higher or lower than the cash income. What do you think? Is it higher? Or current net income, is it higher or lower than the cash income? Cash income will be only for the items that I'm paying cash versus the item that I have accruals. Depreciation expense, does it reduce my income or increase my income? If I don't have depreciation expense, what's going to happen with my income? It's going to go up or going to go down? Can you guys see it? This is with depreciation expense. This is without. What's happened with the income? Going up or going down? Oh, let's copy it here so you can actually see it. If I didn't have the net income, if I don't have the depreciation expense, what's happened with my net income? It's going up or going down? Are you guys there?
Yes, prof.
So what's happened? If I remove the depreciation expense, what's happened with the income? Going up or going down?
Going up.
Going up. So that's exactly what I have to do. So if I have the depreciation expense included in my net income, what do I have to do? I have to remove it. How? By adding it back. So next section will be adjustment for non-cash items. And first, we're gonna add back depreciation expense. So if I add $10, what will be my adjusted cash? Adjusted net income, it's gonna be 40 plus 10, it's gonna be 50. Is it exactly what I'm looking for?
Yes.
Yes. So every time when you see it, so that's why I can have depreciation expense. I can also have what will be that? Warranty expense. But warranty expenses is not cash item. $40, let's say warranty expense is $40. No, let's go $20. So that means here I still have to deduct this $20, which in this case, if I flip it here, I don't have to include it because it's not cash item. So what I have to do, in order to bring it, this income that I'm starting to this income without the non-cash items, I have to add also the warranty expenses. If I added back another $20, then my adjusted income is going to be where my cash income is. That will be plus, this formula plus my warranty expense. And now I'm back to the $50. Make sense? So every time when you have expense which is added in the net income which have no cash equivalent, you have to add it back to get the cash from operating activities. Now what's going to happen if I have a gain on sale of equipment, for example, which is a non-cash item, but increasing my net income, then I have to deduct it. Because if I have here, let's add it here, one gain, not here, after the operating expenses, let's add it here, gain on sale. Of equipment, for example, and my gain on sale of equipment, let's say, is $20. Now, those $20 going to increase my income, correct? Plus $20. But on the gain, there's no cash equivalent on the gain. Because gain is gain. It's just calculation. So what do I have to do? I have to deduct that gain from my calculation. So I have to eliminate this 20. I have to eliminate those 20, and I have to eliminate those 10. So my income has to go down to 50. So once I add, watch this. Once my starting point is 40. Warranty, no cash equivalent, I'm adding it back. Depreciation, no cash, I'm adding it back. And if I leave it the way it is, I'm gonna end up with $70. But I have this gain, which is included in this net income. So what I have to do, I have to deduct it, less gain on sale, $20. So I'm going to deduct that gain. And I come back to my cash income. Now I'm back to the reality that I want to be. This is my starting point here. But I'm moving to my cash net income, which including only cash item and excluding all the non-cash items. Again, if it's expense, you have to add it back. If it's a gain, you have to deduct it. And that's all. Let's finish now the slides for the operating activities. And if you want, we can do some examples So you can actually see in the part of the actual calculation of the operating activities. So let's see this one first. We have this income statement, which shows sales revenue, interest revenue, dividend revenue, gain on sale, that much. Then we have expenses, cost of goods sold. We have a salary expenses. We have amortization expense, other operating expenses, interest expense, and total expenses are that much. Net income before taxes is that much, and we have the income tax expense 36. Net income is 100. Now the question is, then we have this balance sheet. And after that, the preparation of the cash flow statement. Let's start with this first. I'm going to flip it to the Excel spreadsheet that we already have. And let's keep in mind, what we talk about this calculation. Okay? So let's flip it here. Let's make this one bigger first. And let's flip it as a picture right here. I'm going to copy this operating activities. We don't need the formulas. I'm going to copy this and I'm going to paste it right here so we can have it. Not like that, probably going to paste it as letters. And what I'm going to do, I'm going to highlight what we have to add and I'm going to highlight what we have to deduct. Now let's start doing our first part to adjust the net income into the adjusted cash net income. So our starting point on the operating activities for this indirect method is going to be net income. We already know how much the net income is from the statement provided here on the picture. Our net income is $100. Then we have to make adjustment for non-cash items by adding them or deducting them. What we're going to add back? Yeah, we're going to add back if we have depreciation or amortization expense. And we're going to deduct if we have a gain. So let's start with the expenses. First, we have cost of goods sold, most likely that's cash. Salary expenses, definitely cash. Then we have amortization expense. Is that a cash item? We already established it's not, but it's included in the deduction of our net income. So what that means, we have to add it back. So we're going to add amortization expense. And we're going to add $43. Is there anything else that we have to add back? Everything else looks okay. So now let's see if there's anything that we have to deduct from our income. Is there anything related to the non-cash item? And we see sales revenue, interest revenue, dividend revenue, gain on sale. Is the gain cash item? No, it's not. So what we have to do, since it's increasing our revenue, or that means increasing our net income, we have to deduct it to eliminate the effect of increase. Less gain on sale of property, plant, and equipment. Negative $19. So those two gonna give me adjustment to my cash of $42. So my adjusted cash or adjusted net income, sorry, net income. Here on my adjusted net income, in this case is 100 plus 24, $124. And that's how we're moving from the accounting net income into the cash net income. Make sense? Are you guys with me?
Yes, Prof.
Okay. Let's have a break because I believe at this point getting a little bit too much. Let's have a short break and we're gonna continue after the break.
Thank you, Prof.
Everybody agree on the break?
Yes, Prof.
Okay, good.
How many minutes, Prof?
Sorry? How long?
Long.
10 minutes. Is it okay?
10 minutes? Okay.
Okay, okay. Hello, guys. Can you guys hear me?
Yes, Prof.
Let's keep going then. Ready?
Ready, Prof.
Let's go. So one thing, you remember this explanation here and the items that we're including and excluding. The one more thing that I want to add here is, here we have gain on sale. What if we have loss on sale of property, plant, and equipment, and that loss is $10? How this going to affect our income? Loss usually is going to reduce the income, correct? So if we have a loss, what do we have to do with that loss in order to normalize the income? We have to add it back, correct? Not this one. If we have a loss, let's see where we are here. If we eliminate those one, including the loss, gain, this one, and this one. So if we have a loss of 10, we have to add that loss into our normalization for the net income. And that's pretty much covers everything, all the possible scenarios that we may have. That's why I wanted to bring this. So basically, we're going to start with the net income, current net income on the income statement, and we start looking for cash item or non-cash items and eliminating the cash items in this way. So I prepare for you this question. So let's put this one, operating activity. I want to get this operating activity and flip this one. Not that way. Want to copy this one. Sorry, the entire thing. And flip it on our slides here. So we can have it as a reference when we come back a little bit later to this point. That's what we adding. And this is what we deducted in order to come up with the adjusted net income. Okay, I prepare for you this question and I want we to go over this question. And we're going to prepare, in this case, we're going to prepare the entire cash from operating activities. What we have to have in mind, the starting point first. Once we look at the provided statements, those not complete statement, those are partial statements, only for the purpose of preparation of the operating activities, cash flow statement from the operating activities. Only that section of the cash flow statement. So what we need to see is, first we're going to see this balance sheet, which has inventory, capital assets, accumulated depreciation, accounts payable, interest payable. And then we're going to have partial, that will be actually income, profit and loss, sales, cost of goods sold, gross profit, that's a calculation, depreciation, expense, loss, and net income. So starting point again will be the statement of profit and loss in this case. And the net income that we have there, it's 49,000. So now that's our starting point. That will be $49,000. We have that. Then we're going to start chasing the items, which are, first we have to see, do we have to adjust for something by adding it or deducting? That's the first thing that we have to see. do we have to make some adjustments for adding and deducting something to our net income. And what we start chasing is there any cash items? And is there non-cash items which are included in our operating income? And we start sales, usually a cash item that's clear out of picture. Sales are okay. Let me find that tick here, and let's tick in one after another. Sales are okay. Cash. Next one, cost of goods sold. That's also okay, check. Next one, depreciation expense. Well, depreciation expense, that's a non-cash item. Loss on sale, also non-cash item. We cannot pay for the loss and we cannot pay cash for depreciation expense. Now, the fact is that the reality is that those two items reducing this amount. Otherwise will be 56. So what we have to do, we have to normalize our income by adding those two items into our statement, operating activities on the cash flow statement. So let's start. First, what we're gonna add? We're gonna add depreciation expense. And then we're gonna add loss on sale of capital asset. Less, there's nothing not applicable in this case. We're not gonna reduce anything here. So let's add first depreciation. Depreciation is, we're gonna add $6,000 for depreciation. And for the loss, we're gonna add another 1,000. Once we make those adjustments, our adjusted cash or adjusted net income, let's push those one down, and we can come with here with the calculation, adjusted net income. In this case, it will be those two together. It didn't catch it. We're gonna change the formula. We're gonna bring it all the way up to here, and we get it. Oh, that's 49,000. There you go. Our adjusted net income now is $56,000, which is our gross profit. Magically, that's how it become. It's not necessary to be like this. In this case, it's just like magically matching this number, but in reality, that's not going to happen. So we get the adjusted net income. That's a good point. Now, the next thing that we have to do in order to get the operating activity, we have to start looking for the changes in the working capital. Working capital is only current assets and current liability. Now, what we have to do is we have to identify which of the assets are current and which are non-current, and we to include only the current assets. So inventory definitely is a current asset, so we're going to mark it as a current asset. That's part of our operating activities. Capital assets, accumulated depreciations, those are definitely not part. Those are long-term assets. So we eliminating those one. Liability side, first we have accounts payable, which is definitely cash item. And then we have interest payable, which again is definitely cash item, but also part of the current liability, and that's also current liability. So part of the working capital will be inventory, accounts payable, interest payable. Let's mark this one the same way here. And adjustments for the non-cash item, I can mark it with blue so I can match this cover here. So let's start with the first, inventory. On the inventory, what we're chasing is, if you remember the formula that I gave you before, what we're gonna, first item is inventory. And what we're going to apply? We're going to apply the formula that I gave you. That means beginning balance of the inventory minus the ending balance of the inventory is going to give us the change in the inventory. So what we're going to have here? We're going to have 73 minus 70. What that means to us? Beginning balance of the inventory was $73,000. Ending balance is 70. What that means is that means we sold that inventory. Instead of 73, now we have 70. So $3,000 of our inventory beginning balance has been sold. That means that's mean cash for us. And is that positive amount? Yes, it is positive amount. So that means everything is correct. By reducing the inventory means we increasing our sales, means we getting more cash. Now let's see on the liability side. Now the liability, since we're doing everything here on the positive and negative, what we have to do is we have to keep in mind assets affect the cash in the positive way. Liability affect the cash in the negative way. So every time when we have an asset, we're gonna add beginning balance minus the ending balance. When we have a liability, we're gonna deduct beginning balance minus ending balance. How this is gonna happen? I'll show you right now. Accounts payable is first account, and what we're gonna do is slightly modification on the formula. We're gonna have minus bracket beginning balance of accounts payable minus the ending balance of accounts payable. And that minus in front of the bracket actually tells us that this is an outflow. Why? Because it's related to the liability. So let's see what will be that. Again, will be equal to minus bracket beginning balance minus ending balance, close the bracket. And in this case, it doesn't show me the value because I probably have to, those are the, if I put here 55,100 and here 56,000, that's gonna solve my problem. So what that means to us, let's think about it for a second. My beginning balance of the accounts payable was higher, 56. Now is with $900 less. What that means to us means that we pay all our expenses, plus we pay additional $900 from our beginning balance of accounts payable, reducing the account payable with $900. In cash, that means we pay extra $900 less, more cash. And is that a reduction in the cash? Yes, it is. So everything is fine. Interest payable. On the interest payable, we're going to do the same thing. Since it's liability, we're going to plug this minus here in front of the formula, and we're going to have beginning balance of the interest minus the ending balance of the interest account. What will be the formula here? Again, equal to minus bracket 2,000 minus $3,200. That's positive $1,200. What that means? In the beginning of the period, we had to pay 2,000. At the end of the period, we have to pay 3,200. The question is, did we pay for that expense? For the interest expense? And the answer is no, we didn't. How this going to affect our cash? Well, we're saving on the cash. So basically, because of the increase in our interest payable, we're paying less cash. So that means $1,200 cash, we have it available sitting in our cash. Because of the working capital changes, we have a positive cash of $3,300. So our cash from the operating activities in this case will be not 3,300. We have to adjust the formula to include all the way this 56. Our cash from operating activities in this case is $59,300. And that's how we get the operating activities on this question. Now, whatever we learn here in terms of the working capital, let's apply it to our question from the slides. Since we already come up with the adjusted net income, that's our first point, to get the adjusted net income. When we're adjusting it for the, let's say, for the depreciation, warranty expenses, and loss by adding those and deducting the gain. We already did this. So now let's change this one to green. And let's move now to the working capital. And here we're going to add changes in working capital. And let's see from the next statement, which is provided to us on the slides. I'm going to copy the next statement. We're going to see what kind of changes we have to make. Now I'm limited on my ability here to work with this because I cannot highlight everything, but let's think about something. We have the balance sheet, we have the assets. They're not structured current long-term, so we have to do this structure by ourselves. And the same thing with the liability, they're not structured by the current and long-term, so we have to do this by ourselves. Luckily, on the site, there's some notes. But let's start exploring. Changes in the working capital. First, cash. For the cash, we're not doing the cash because with the cash flow statement, that's what we're chasing. That's why we're doing the cash flow statement to see why our cash decreased with $44 compared at the end of this year compared to the beginning of the previous year. But the next item that we can see here is the accounts receivable. Accounts receivables is definitely a current asset. So let's go with the accounts receivables and apply the formula that we already have. Beginning balance of the accounts receivables minus the ending balance of the accounts receivables. It's going to give us a change in the working capital, either positive, either negative. So let's see, our beginning balance in accounts receivables is 192. Ending balance is minus 224. So because of the increase in the accounts receivable balance, we miss opportunity to collect our sales for the period. And our accounts receivable increased with $32. That means we didn't collect $32. That's a reduction in our cash for the $32. Let's go with the next one. Interest receivable. Formula is the same. Beginning balance of the interest receivable minus the ending balance of the interest receivable. And that's equal to interest receivable beginning balance is 3 minus 8. So we have the interest revenue, but for that interest revenue, we didn't collect $5. Why? Because whatever that beginning balance was $3, if we beginning balance is equal to the ending balance, that means we collecting the interest revenue. If the beginning balance is less than the ending balance, that means we adding more to interest receivables. So whatever interest revenue we generating during the period, we haven't received it yet. So that's a reduction in our cash with the $5. Let's see inventory. What's happened with the inventory? Again, beginning balance of the inventory minus the ending balance of the inventory. In this case will be 330 minus 323. And we have increased with $7. What that means? That means that we reduce our inventory. That means we increase our sales with $7, which means we get extra cash of $7 by reducing our inventory, which makes sense. Next current asset is prepaid expenses. Prepaid expenses is current asset. And the formula is the same. Beginning balance of the prepaid expenses minus the ending balance of the prepaid expenses. Our prepaid expenses of the beginning of the year was 17. The ending is 18. So that means we paid more. We're increasing the prepaid expenses. We pay $1 additional. So that means reduction in our cash with $1. Next one is long-term receivables. We not worry about that because that's a long-term asset. That will be part of our investing activity. And then we have the property, plant, and equipment. Again, that's not part of the operating activity, so we're going to ignore that item. We're done with the assets. Let's move now to liabilities. First liability that we have, and again, when we're moving to the liability, keep in mind, this now is outflow. Up to this point, that is in cash in. The now is cash out. So let's see. First one is the accounts payable. In accounts payable, since it's a liability, don't forget to plug that minus in front of the formula. Beginning balance of the accounts payable minus ending balance of accounts payable. So how it's going to be? Minus bracket. We have 137 minus 220. And we have increase in cash with $83. Is that true? Let's think about it. Well, obviously, we had to pay $137 in the beginning. During the period we purchase, and at the end of the period, we have to pay more, 220. So that means we save $83 on cash. We didn't pay for our expenses. So that's going to be a positive for our cash, which is reflected here in the formula. Next one, we have the salary expense. Again, since it's expense, we're going to put a minus in front of the bracket. Beginning balance of the salary expense minus the ending balance of the salary expense. And in this case will be negative 12. So negative bracket 12 minus 6. And that shows decrease in our cash with $6. Is that make sense? Well, we reduce our beginning balance. That means whatever expenses we paid it, plus we pay additional $6. So that will be extra reduction in our cash. Totally makes sense. Let's go with the next one. Accrued liabilities. I want to put it accrued liability because accrued liability usually is not cash item, but let's I'll probably put some interest expense or interest anything like that, interest liability. But anyway, let's do with this accrued liability negative beginning balance of the accrued liability minus the ending balance of accrued liability. So what's happened here? We have the formula equal to negative bracket 7 minus 5. So what happened is we reduce our beginning balance with $2. That means we pay extra $2, which is shown here in our calculation. That means everything okay. Next part is long-term debt and common shares retained earnings. Those are part of the financing activities. We're not going to deal with those. So how much is the net change? Net change, if we do the calculation, is $44. So our cash inflow, since it's positive, from operating activities is equal to 124 plus 44. That's not the right number. I have to extend it all the way to include the 124. Our cash from operating activity is going to be $168. Now, let me make some adjustments here. So first, let's move those borders. This one I can easily cut it from here, paste it here. Need one underline here. And that will be net change in cash in the working capital. Net change in working capital. And we have that number 2. And that's the cash flow from operating activity. We can close it in that way, that fashion, with that font. So let's see what the question says. Let's go back to slides and see how the slides treating this particular question. So preparation of the cash flow, indirect method. First, what we have to do, we're starting with the income. Then we're adjusting for the non-cash items. First, we're going to add the amortization expense. And then we're going to deduct the gain. Then start chasing the changes in the working capital. We have increase in accounts receivables, which is reducing our cash with $32. We have increase in interest receivables, which is a reduction in our cash with $5. Decrease in inventory, which is positive for our cash, $7. Increase of prepaid expenses, negative $1. Increase in accounts payable, since we're not paying accounts payable, we're saving the cash, that's $83. Decrease in salary expenses, that means we're paying extra salary expense at $6. And decrease in accrued liability, $2. So the net effect is $68 combined between the changes in the adjustments for non-cash items and changes in the working capital. Total is 68. Let's see if that's true in our calculation that we did. In our calculation, we have 24 here adjustment plus 44. The net change is 68. And that's how we're moving from $100 net income starting point into the 168 on the operating income. So net cash flow from operating activities is $168. That's how we calculate. Now the preparation of the operating activities, again, now there's explanation. How we starting, what we adding, what we subtracting. Again, we adding back any non-cash expenses has to be added back. Plus, we adding back the losses. We deducting gains. Then we going with the working capital. First, we chasing the current assets. Every time when we see the decrease in the current assets, means positive to our cash. If we see increase in our assets, that's a negative to our cash. Current liability, opposite. If we're decreasing our liabilities, that means we're using extra cash. If we're increasing our liabilities, that means we're not using that, we're not paying those liabilities. That means that's positive for our cash. So that's one thing that I want you to have it in mind, but don't follow it blindly. Now, amortization, depreciation expense, added. Gain, deducted. Losses, added. Now, decreases in the current assets is cash, negative on the cash, decrease in the current asset, positive in the cash, on the liability is the opposite. However, pay attention to this. If every time when you're doing the cash flow statement, if you follow this formula, beginning balance minus the ending balance for the assets, and minus bracket beginning balance minus ending balance for the liability, you're never gonna make mistake. Again, if you follow those formulas that I'm giving you here, you're never gonna make a mistake. The other thing that I have to tell you, I'm the only one I can clearly say I'm the only one in Canada that teaching cash flow this way. Nobody else teaching cash flow this way. So if you get it, and if you follow this simple formula, again, you're never gonna make a mistake. All the textbook give you, all the teachers giving you some other, basically the teachers follow the textbook. They don't thinking about this and they don't come up with anything. So again, follow it. And even if you're moving to another courses with another teachers, follow these simple formulas. You're never going to make a mistake on the cash flow. Cash flow, you have to do it in that course 331. There's a chapter of 1, 2, 3, 4, chapter 5. Chapter 5 dealing with the cash flow. If the teacher is using textbook, but in Alexander, they're not using textbooks. So I don't know when this is going to happen. But again, if you follow these simple formulas and if you follow this cash in, cash out, and knowing that the only difference between the direct method is indirect method is in the direct method, you're including the sales and expenses. In the indirect, you don't. You're just checking beginning balance minus ending balance. Beginning balance minus ending balance. But when it's outflow, you put the minus in front of the bracket. And that's it. And you're there. Let's go now to slides and see what else we can cover. And next time, what we're going to do next time, since we have, I believe, 2 more classes, next time I'm going to spend more time on the cash flow statement and we're going to start doing the cash flow statement as questions. I want you to go through some questions so you can understand the questions. So now let's move to the investing and financing. On the investing, we're dealing with the long-term assets, property, plant, equipment, intangible assets, investment, not receivables. What's interesting with those? Investing activities, we have a beginning income statement amount, and then we have to adjust for the balances related to the balance sheet. Now, the revenue expenses from the investment from the income statement plus adjustment, beginning balance minus the ending balance is going to give us the amount of the cash flow on the cash statement. Let's see now here. Property, plant, equipment. We have beginning balance, net amortization, 525. What means net amortization? Means that the amortization was already taken out. Ending balance is 1,087,000. During the period, we purchase a new property, plant, and equipment for 735. Now, the income statement shows that the amortization expense for the period is $43,000. And we also see on the income statement that we have $19,000 gain on the sale of the property, plant, and equipment. Now, the question is, what's happened in this account and how are we going to deal with it? So I'm going to copy this example and I'm going to put it in the Excel spreadsheet. So I want you to see this. Okay. Let's make it bigger. So we have this question here. Let me see if you see my screen. Yes, you see my screen. So what we have to do, we have to open this account. The easiest way is to open the account, property, plant, equipment account. That's property, plant, equipment. What's happened with this account? We already know what's happening here. That this is the balance sheet account, long-term liability, long-term assets, which has a beginning balance and has the ending balance. Some things happen in this account. As you can see, we have a beginning balance of net of 525. What else we have? We already know that we have a purchase. And our purchase is for 735. Now we have the ending balance, which is 1087,123. And we have amortization expense. That's amortization expense account. Let's open this account as well. That will be only this part I'll need. This one's gonna go. This one's gonna go away too. That will be my amortization account, amortization. Account, and I know that my amortization expense for the period, there's no any balance on this account since it's income statement account. Let's delete those two lines. I don't need those one. That's too much. And my ending balance is gonna be here. So my amortization expense for the period is $43,000. What else I know? I know that I have a gain on sale of the property, plant, equipment, $90,000. So what that means? I sold something. Make sense? I sold something. What's the general entry? Journal entry to selling asset. Debit. Obviously, I'm getting cash. And once I sell it, I'm gonna get cash. Since I sell it, since I'm selling it and getting cash, I don't have the asset anymore. So credit will be property, plant, and equipment. I'm gonna reduce that one. But magically, that property, plant, and equipment comes with the amortization. So the other debit will be amortization, accumulated amortization. Right? And on top of that, I have a gain. Now I know the gain is on the credit side, not on the debit side. So I have a gain, credit, gain. Sorry, that's not going to be here. Credit gain is going to be here. So now I have to plug the numbers and figure out what is what. So this is more like a solving the puzzle. My gain is, I already know, my gain is 19,000. So what I have to figure out? I have to figure out how much went out from what's the net amount of the property, plant, equipment, which is property minus accumulated amortization. And from there to find out how much is the cash. I don't know this. I don't know this, and I have no idea about this. That's what we have to figure out by having all this information. How we can do this? Well, on the property, plant, and equipment, once we look at this account, I have this. So at this point, am I in balance? What means is if I add 525 plus 735, I'm not in balance. In fact, I'm out of balance with this one minus this one. I'm out of balance at $173,000. Okay, what do I know? If I'm working with the net amount, that means amortization expense, accumulated amortization directly affects my property, plant, and equipment. So I'm going to have here accumulated amortization. And I know how much is my accumulated amortization. That's accumulated amortization is $43,000. Okay, so if I'm $43,000 on accumulated amortization, and that's directly included in my calculation for the net assets, what will be the cost of the property, plant, and equipment with accumulated amortization included inside? So that in this case, with this journal entry, I don't have to work with this. I can eliminate this and net. I can put here property, plant, and equipment net of amortization. So let's check this one. Where we are. I'm this one plus this one minus this one minus something else that I've sold should be give me the ending balance. So far I'm off $130. So what that means? That means my property, plant, and equipment sold was with a net value of $130,000. If I plug $130,000 here, my problem is solved. So what do I know? I know how much is the net amount of my property, plant, and equipment, which is $130,000 by solving this problem. Can I get how much cash I get? Well, obviously I get $139,000 cash. Or that will be equal to this amount plus this amount. So my cash that I get is $149,000. Again, at this point, at close to the end of our lecture, I don't expect you to be super sharp with this. For that reason, we're going to practice this a few more times so you can actually understand it next time. But I want you to introduce it so you can understand what's coming for you. So, how are we dealing again? First step is draw the T account, beginning balance, ending balance, how much we purchase, add the amortization. Since we're dealing with the net of amortization, here we're selling, as you can see, all the balances here net of amortization. That means accumulated amortization is already reflected in this account. That's why net is highlighted. For that reason, we have to subtract the accumulated amortization, and that's how we're getting by solving the equation for the ending balance, that's how we're getting the book value of the asset sold. Now, again, from the journal entry, we're getting cash, we're selling the asset, and we're having a gain. So how much cash we get? 149. And that's how you're getting it. Now, we're going to have a similar approach if we have to get the proceeds from sale. Again, cost of the investment. If we have a gain, you're adding the gain. If you have a loss, you're reducing the loss. And that's how we get the sale. So on the financing activity is going to involve long-term liability and equity. With the financing activity, we're going to continue next time. I think that's more than enough for today.